also heard you mention the C fund. So that's more like a growth oriented fund. Is that keeping pace with the market? Is it more high risk? Is it more volatile? Of course, it has to be more volatile than the G fund, but can you explain the
Yeah.
C fund and how it
So
operates?
yeah, sure. So the S&P 500 stands for Standard and Poor's 500. It's the top 500 companies in America. Now, the interesting thing about the S&P 500 is that on January 1st of any given year, you got a list of 500 companies. And if you look at that list December 31st at the end of that year, it may not be the same 500 companies. Because
Right.
some of them are going to fall out, which means something is going to jump in. There's a lot of opportunity there for your money to grow over a long period. So, yes, there's a fair amount of volatility there. The S fund is a little more volatile because it's the 501st company down to the bottom, but
Right.
they may have an explosive growth and jump up in there. So you can get that, but you also can have a really explosive downturn.
Right.
So these funds are very volatile. That's okay because here's a misconception. People will say to me, oh, wow, the market went down by X percent and I lost X amount of dollars. Well, you only lost the money if you moved it out of play. This is what I mean. If you're in the C fund or the S&P 500, and let's say the market goes down by 20%. Well, all that really means is that the value shrank by 20%. You don't lock in the losses until you move out of that fund,
Okay.
right? And so there are a lot of people out there that will move the money in the TSP to the G fund. I don't want to lose any more money. Well, you hadn't lost any money. You just had a smaller value, but you lost when you moved it. The second thing to remember about investing is this, especially if you have a long time before you retire. Let me do simple math. Let's say you're putting $1,000 into the C fund, right? Every paycheck. So federal employees get paid 26 times a year. Let's just say they're doing it every pay period, just to keep the math easy. And
Hmm.
let's say that one unit of the C fund costs $100. So
Right.
that means you're buying 10 units, right?
Right.
If the market dropped 50%, that means the C fund now costs you $50 instead of $100.
Correct.
But you're still putting $1,000 in because you're not changing what you're putting in. We
Right.
call that dollar cost averaging because it's coming out of your paycheck every 2 weeks. So that also means that what you paid full price for at $100 a unit now costs $50 a unit, but you're putting $1,000 in. So guess what? You're buying twice as many units for the same
Right.
money.
Right.
And when the market goes back up again, the stuff you paid full price for goes up along
Yeah.
with the stuff that you bought on sale. So
Right.
market dips like what's going on right this moment, if you're working, is your friend because you're still buying stuff. So you're really buying stuff on sale. Eventually the markets will stabilize. They'll start to grow again. Because the thing about markets is this, they don't like uncertainty. And so we have tariffs, we don't have tariffs. We're going to impose them, we're not going to impose them. There's a lot of back and forth and uncertainty right now. So the markets are uneasy with that. That's why you're seeing, as of the taping of this, which is March 7th, a lot of up and down in the market. But
Right.
once people figure out what's going on, they will become resilient again. I'll just throw out this one little fact. The S&P 500, which is, and I talk about that a lot because that's the market that most people are familiar with,
Hmm.
started in 1948. There's been 16 downturns since 1948 in the S&P 500. 94% of the time, there's at least a 2-year run up after those downturns. 67% of the time, there's at least a 3-year run up over a long period of time as you are feeding money into these assets. When the market goes down, please buy stuff on sale. Don't run, buy it on sale. And then it's going to go up for 2, maybe 3 years or more. The most recent history is when the market went down in 2008, 2009, about almost 50%. It was 40 something percent.
Yeah.
Guess what, Carlton? It went up 220% after that for about 10 years.
Yeah.
So
Yeah.
if you moved your money out of the market and you didn't get it back in at the right time, you missed a 220%
Yeah.
rise.
Welcome to the I Triumph Real Estate Blueprint Podcast, where greatness awaits you.